I think that we should probably kick it off since the world is so complicated. You can kind of solve and figure out what's happening out there. I know you've said that we're kind of looking at an economic generational shift. And so what does that kind of mean for the world, and what does it mean for the markets, and how should we be thinking about that?
Let's definitely have some fun. Thanks for having
Absolutely.
me. Really fun to do this with you in particular. You know, I think that when you look at investment returns over a period of not years, but many years and decades, you tend to have very big secular forces that kind of drive the environment that you're in. And all of us that have been investing, we've basically invested in one paradigm that got way accelerated the last 15 years or so. And that's been a paradigm of massive globalization, integration around the world. The US is a security umbrella to everything, just a certain geopolitical paradigm that was deflationary, that allowed for very easy money, and in the last 15 years made the United States such a winner that pretty much the best thing he could have held was a simple S&P 500, no questions asked, no fees paid. That's the best you could have done. But where that leaves us is that, you know, when you look around today, it's hard not to feel that we're fundamentally in a different place. That it's certainly accelerated under President Trump, but it didn't happen just the day Trump was elected. There's been quite a few years now, certainly since Trump won, of a realization in the United States and other countries that there's some dissatisfaction with some of the elements of the past paradigm, some desire to shift that. And you know, we've called the new environment modern mercantilism, meant to describe kind of a worldview that the state's job is to really maximize that country's, its national wealth, its strength, its self-sufficiency, and that manifests in all kinds of ways, including looking at trade deficits as a transfer of wealth, as something that needs to be avoided, that needs to be handled, as thinking about self-sufficiency and what gets made in your country, and as willing to handle your traditional allies in, you know, much more kind of coercive ways. And that new paradigm is only starting to be priced in markets. Markets have barely started pricing it in. There's going to be ups, there's going to be downs. You're going to get tariffs up, tariff down, announcements. But at the end of the day, that's a very fundamentally different paradigm to be investing in, and one that's starting from a pricing that's assuming the old one, because we don't have the prices today we did in 2010. In 2010, we looked at a world that was pricing, you know, much lower profitability and so on for U.S. companies. Now the assumption that, you know, you got to keep beating what you got before is even stronger. So how about you? You're also looking at the world, seeing lots of things.
Karen, I think you hit on a lot of key things we agree with. You know, the one area that I think has been very interesting that we see is that global investors are so long corporate America in every kind of asset you can think of, whether it's, you know, private equity or private credit or equities or venture. You just go down the list, and it's not only U.S. investors, but it's global investors. So I think what we've seen recently is this shift also of investors saying, okay, how much of my money do I want to have in the United States? So that's a shift that, as you're saying, is going to take a while, and it's probably just in the early stages. That makes it very difficult to think about the dollar and think about asset prices in general. I do think, though, that U.S. exceptionalism in the private sector is still here. I think it's still with us. I still think we have a massive edge in technology. I think we have a massive edge in financial services and capital markets. And I think that's a huge advantage for the United States. So it's not going to be easy that the money leaves the U.S. What we see an opportunity here in this kind of world that's going to, we think, siloing now, where you're going to have kind of the Americas, you're going to have the Europe, and then you're going to have Asia, is that there's some opportunities in places like Latin America where there has been, you know, left for dead for the last 25 years since the tequila crisis. And what we see now, there are significant political shifts. And, you know, we look at countries like we look at companies. You know, first thing we look at is management, and how good is management, and what are the policies of the management. And we're seeing now that big change in Latin America where management's changing. I think Malay in Argentina is the best example of that. Good management, good policies, and now we're seeing that potentially spreading to the rest of the continent. And we have four big elections in the next few months, next 18 months, in Peru, Colombia, Chile, and Brazil. And we think that's going to usher in substantial change in the region. And the great thing about Latin America is you can make huge returns in equities, but also in currencies, credit rates, because rates are high, currencies are cheap, and there's a huge room for massive improvement. So we see lots of dislocations. We think it's a very tricky world. We think you have to have shorts. We like the fact you have to protect your portfolio at certain points here, and you have to be dynamic.
So I completely agree that this shift away from U.S. assets, it's not something that happens in a day. And it's something that investors are just starting to understand the magnitude of how reliant we've become as a country, that the flip side of a massive trade deficit is a huge amount of current account inflows, that people are buying all of our things. And that doesn't go away in a day. It's primarily U.S. allies. This is not the Chinese are buying assets. And you start talking about this fractured world. In every one of these regions, I think there's going to be more and more of an impetus to say, if the United States is so hell-bent on being self-sufficient, why aren't we? Look at what Germany did. They said, we should make our own defense, make our own infrastructure, so there'll be more opportunities to actually have capital stay at home. And a little bit of a stress to say, if I'm already 75% in the United States, where should I be? Now, I also like some of these Latin American countries. I particularly like the currencies in places like Brazil and Mexico. What I really like about the conversation you're having, though, is that it takes geographic diversification seriously. And when you look at the market cap of Brazil or Mexico in a world index, to say it's negligible, you're not getting anything.
I have to tell you a funny story about that. So the Monday after DeepSeek came out on Friday, and over the weekend we got to think about it, and then NVIDIA's market cap fell on Monday, right? It fell by 2 Mexicos. So that's how significant, how undercapitalized Mexico
and
is.
Brazil used to be actually large relative to Mexico.
Yes.
Now at this point, it's basically equally negligible.
Right.
And so, the number one thing I think I've been telling investors as the world is changing is take geographical diversification seriously.
Yeah.
Everybody is heavily in the United States because people, admit it or not, they're really guided by market cap. And I understand why. There's a lot of governance issues that make that easy. And you think in market cap terms, it's not liquidity is not important. But it leaves every investor around the world extremely concentrated in the United States, extremely vulnerable to a world where the US doesn't just keep beating everyone. And the most fundamental form of diversification is to be in countries that actually have a different system, that actually have a different beat of the drum, different growth, different inflation, different monetary policy, where elections actually matter to what happens to those companies. So Latin America's one, Asia's the clear other one, where you have markets of a decent size that have been ignored for a long time, and where you have a lot of fundamental diversification to what's happening around the world. So I think treating diversification seriously, both in terms of where you are in the world, that just takes you somewhere else, also treating it seriously in terms of how are you going to do depending on what happens to the economy. I think there's very clearly some degree of economic slowdown ahead of us and some inflation ahead of us because of the set of policies. Certainly the last 48 hours or so have taken some tail risk off the table. We're less likely to have the kind of massive pace of factory shutdowns and empty shelves we could have had, but that doesn't mean there isn't some amount of slowdown. Most people's portfolios are not prepared for that. And thinking seriously, like you said, about liquidity and shorts. We've shifted to a world where people have smaller and smaller allocations that are actually liquid, that actually can respond to conditions as they change. And more portfolios are constrained by how much illiquids they've done to take advantage of all the pricing opportunities that are going to happen. And I think both you and I see that pricing opportunities are going to happen in this environment.
Yeah, this is a great environment to invest globally for sure, and to use all the tools in the toolbox, I think. The other interesting thing I think is, and I think we differ a little bit on this, but I actually think at least rates in the U.S., I think rates in the U.S. are going to back up, particularly in the 10-year sector. And I'm kind of thinking that we're going to hit 5 to 5.25 this year. And then from there, I'm not sure. But I do think the economy is going to pick up as we move into the third and fourth quarter. I think next year's a boom in the economy in the U.S. on the back of significant fiscal tax cuts in particular, with less spending cuts than they're talking about. And at the same time, I think you're going to see the reshoring come and have an impact. And the uncertainty around the tariff stuff will have kind of ended. So I think you'll see companies and individuals spending more. So I think next year is going to surprise everybody. I don't think the Fed's going to cut any rates this year, and I think rates back up.
I think that I agree with you that 26 is where you start getting the stimulation.
Yeah.
25 is where you get the pain from the tariffs. 26 is where you can actually get the fiscal stimulation actually hitting. And the reshoring we know takes time, and the faster you buy down on uncertainty, the faster the reshoring can actually happen. Meaning the more you get out of the paralysis mindset where no business can possibly decide to reshore because they have no idea what they're going to be, what they're going to be facing, the faster that can happen. So I think all goes well. You start getting that boost in 26. I like fixed income a lot more in other countries than the United States because I think that other central banks For them, easing is just more straightforward, right? They're looking at a situation where, for them, whatever slowdown is happening from all the tariffs, it's not created by them. They don't have the same inflationary impulse. As much as the Fed can say, look, ideally, an inflationary impulse from the tariffs is a one-off. It kind of goes through like a VAT tax increase and fades. But you don't know for sure, and the more it comes with supply problems, the more it looks more like a COVID where demand is there, but the supply is on the other side. You can get more of an inflationary problem. It's a tough environment to proactively ease, and the more certainty they get, like you're saying, that either reshoring is coming or fiscal stimulation is coming, why ease into that? If you're in other countries, it's much more deflationary, right? Look what happened to the currencies of other countries. Look what's happening to energy prices. When you get that slowdown going through the global economy, even with the magnitude that it is, I don't know, 0.5% of GDP, easing into that feels a lot more comfortable, and there's not a lot of easing priced in. Everything's kind of pricing off the United States. I also think that part of the backup you're seeing in treasury yields is that you kind of started this environment with nothing really looking like a big risk premium on treasuries. If you said, what am I getting for treasury versus cash? Probably not much. And it's not unreasonable for people around the world to say maybe treasury should have some risk premium, some.
Yeah, I agree with that. So where does this leave you in terms of some of the things you really like and you have high conviction in, and some of the positions that you think are really attractive looking forward?
So I really like fixed income government bonds outside the United States. I think it's a great time for that. You know, many people here know we're fundamental, we're also systematic, and so we can kind of measure the strength of the pressure relative to history. And I think in some of these fixed income markets, it's like once every 10, 15 year type size, so it's not the biggest ever. But
do you think Japan continues to raise rates, and do you think yields back up in Japan?
I'd say maybe. Where are you in fixed income across the board? Then I'll go to a little bit of curve.
Well, I'm that the U.S. is going to force rates in most countries higher. I think Japan goes higher and the U.S. goes higher. I think those are the two clear shorts. I think something like a Brazil or a Mexico, Argentina, Turkey are places where rates can come down a lot. And so I want to play where rates can come down thousands of basis points, or at least hundreds of basis points. I don't know Europe. I'm not sure. A lot's priced in Europe, and so I'm not sure.
I think the UK is probably the most attractive, where you say rates can come down. What am I getting? Yeah. And then I think currencies are also in the size of, you know, once every 10-year type pressures, especially if you look at the big crosses like euro and yen, where you really say, why wouldn't you get inflows into those countries? Why wouldn't you get outflows out of the dollar? How much is behind us and how fast can people move? I think the dollar move so far has been primarily people who are either speculative or are able to do things really quickly. Like I can just put on a hedge and be done. And lots of the big currency drivers don't work that way. They're going to take a while to work through governance. And so I like shorting the dollar, not against everything, but euro, yen, kind of the big crosses. I think other than that, it's kind of like a okay time to take risk, and certainly not the best time ever to take risk in the United States in particular. And so generally, if you're kind of saying, how much risk should I have on and where should it be? Which I think at the end of the day is probably the most important fundamental question you're asking as an investor. My answer would be, it's not the best time ever to take risk, but mostly take it outside the United States.
I kind of would agree with that. I think that there are great opportunities in the U.S., but there's a lot of landmines as well. So we have probably 70% of our risk outside the U.S. and probably half our risk in EM. And as I said, we like Latin America quite a bit, and Argentina and Mexico be our two favorites. We think Brazil in 26 can be the best performing market in the world. We're just a little worried about what Lula might do in the next 18 months, and a little worried about the fact they've had to hike rates 500 basis points in the last few months, which will have some consequences. So we're looking at that very closely. And then I like currencies like a place like Nigeria and Turkey, where they've had big devaluations and interest rates are incredibly high, 30% in Nigeria, 45% in Turkey. It's a very interesting opportunity, I think.
Yeah, well, you obviously have a broader emerging market footprint than we try to do, smaller fund.
Yes.
But I will say, people are constantly surprised that our China-only and Asia ex-China-only funds have been our biggest winners because it feels so counterintuitive. And I think the reason it feels counterintuitive is that the vast majority of investors, when they go into a country, they just buy the stock market.
Right.
And so the idea that you could make money in a place, even if the stock market doesn't do well, feels baffling, but there's no reason to invest that way. And neither one of us do. Both of us invest kind of across the spectrum. And so when we go into China, look, Chinese stocks are extremely cheap, and you got to think about valuation, and there's certainly a path where they stimulate and you get something out of the stocks, but it's not the only scenario.
Sure.
And so far, being in China, being able to also profit from the fact the economy's actually been weak, that bonds have been a good buy, that the currency has devalued, has given us much more of a range of being able to make money in a country without it being just stock focused. And it just brings back the point of, this is a great time to not be stuck in a paradigm that says, I only buy stocks and I only buy US stocks.
Right.
There's lots of assets to buy. There's lots of places to be around the world. There's no reason to be that concentrated. And so far, performance in 25 just gives you a clear sense that that's not the only thing that can do well.
Yeah.
There's going to be lots of opportunities, and you have to be nimble enough to actually be able to take them.
We haven't talked at all about credit. Is there any strong views on credit?
No, I mean, we are not single-name credit investors. We'd love to hear what your thoughts are.
We do very little single-name stuff. Occasionally, we do more sovereign-type credit.
Anything you like? Is this a big area of risk for you?
No, it's kind of the same countries I've been talking about. Argentina, I think you still get paid a lot for that. I think Nigeria, you get paid a lot. Ecuador, but they're very specialized and very, very specific. And you have to have big returns. Overall, in credit, we don't have a strong view either. So maybe that's why we didn't discuss it.
Well, I will say a big thing I have seen kind of across the institutional clients we work with is that fixed income capabilities have generally kind of been degraded because so much has moved to private credit. And so sort of the average institution, if they used to hold fixed income because the goal was more or less, if there's a recession, at least I'll get some easing, and that'll be kind of balancing out of all my risky assets. When rates were zero, that seemed extremely uninteresting. And there was sort of collateral damage from the more alpha teams that are actually picking where to be on the curve and which countries, credit, because it just kind of got hollowed out. What's the point of owning this stuff if rates are zero anyway? A lot of money went into private credit, which can have totally great returns. The issue with private credit is that you tend to get, depending where you are on the risk spectrum, something much more similar to equity-like risk. And so those uncorrelated opportunities that come from selecting names and sovereign risks, choosing where you are on the curve, even being able to select, I was talking earlier how I like bonds outside the United States better. You won't believe how many people tell me, well, I don't buy any bonds that aren't U.S. Treasuries. My mandate is just U.S. Treasuries. I used to, but at this point, rates were zero everywhere. Who cares? So stepping back into that space, I think that generally duration and currency are great alpha spaces that have seemed uninteresting for a while when rates were zero and are kind of coming back in a big way.
I agree with that.
Where else do you guys think?
The other I like oil. I do like oil, and I think oil, when it got down to 55, was a very interesting buy. We bought it between 55 and 58, and I think we can't underestimate the risks in Iran and Israel and what's going to happen there. And there's no way that Israel is going to allow Iran to stay nuclear. So something's going to happen. I think something happens soon, and that could have a major impact on oil prices. So I think the risk reward in oil prices is phenomenal right here. Long term, I'm not sure, but near term, I like it a lot.
So I don't tactically like oil that much, but I will say that it fits into the category for me of another kind of ignored area where you just haven't had any inflation in so long that it seemed uninteresting. And so it's taking the kind of run we had in gold for people to start saying, wait a minute, why aren't I looking at gold? That just hasn't happened in commodities. But the entire commodity complex, gold, of course, being a unique commodity within that, these are useful assets. You're clearly looking at a world that has more inflation risk than it used to. So even though tactically I don't think I'd be buying oil right now, I like gold better tactically. I do think that, again, these are kind of ignored asset classes.
Gold's had a big run, and everybody's long, and oil, I think people are short. So I think technically, in the near term, you could see a big spike in oil with gold not performing as well.
Any single names you want to talk about? This is such a single
Well, I tell you what, my favorite single name is American Mobile, AMX, in Latin America, because it's basically in all the major countries in Latin America, so you get exposure to all of them. And it has huge moats in their business, generates 10% free cash flow yield, trades at 4 times firm value EBITDA, growing at 10%, buying back 7 to 10% of the stock a year. And Carlos Slim's the major shareholder, and you can trust Carlos. So that's an amazing stock, and it's, I think it's about poised to do very well.
Another one you would not get a lot of exposure to if you're just a benchmark investor.
No, you would not.
You kind of be irrelevant in your portfolio.
Yeah. So. And it's a $55 billion company, so it's not small.
Well, it's been a lot of fun. What I love most about pairing the two of us is that I think our portfolios are some of the most different from what everybody's holding, and that it's just a great time to pause and say, is this what I should be holding? Where else can I be in the world? And what would be diversifying to what I hold? There's so many zero correlated opportunity assets out there relative to how underutilized that
Totally
is.
agree.
So.
And I found out you're a Pittsburgh Steelers fan, so that was even more surprising.
I would say my understanding of the sport of football is relatively limited, but I am a deep Pittsburgh lover, having spent some years there. So I think
Right.
that qualifies me.
It qualifies you. Great. Thank
Thanks
you very
a lot,
much.
Rob.
It was a pleasure, Karen.
Real
Thank you.
pleasure.
Yeah.